I have to say that I've had the pleasure of crossing paths with President Mester numerous times over the past years. I remember it fondly. You may not remember it at all. But I first met her in her role when she was the director of research at the Federal Reserve Bank of Philadelphia. And we have a sister organization in Philadelphia, the Philadelphia Council for Business Economics, and Luke Tilley is the president this year. Welcome. So I would go down from time to time and speak to them, and the Philly Fed was always gracious in hosting those luncheons. And President Mester would, well, she wasn't President Mester then, but she would come into the room to listen to the speakers. And once she became president of the Cleveland Fed, it gave me a lot of comfort knowing that she was someone who likes to reach out to business leaders and the community and other economists on the private side of the equation to get views, just a broad range of views of how are people looking at the global economy, at the US economy, and at monetary policy. You know, today you may or may not agree with the views presented today. But what you can know is that they are objective, they're well-informed. I will have to say, and this is where I go off script, so it's dangerous. Right after President Mester took over at the Cleveland Fed, I think she was asked the typical question, are you a hawk or a dove? Which I can tell you is probably very irritating. And she's neither. She's still foul, right? She's an owl. No, that's my little joke. She's still a fowl, she's an owl, a foul owl, I guess. But very objective, right? And I thought that it was a great answer and something that I'll always remember. So that's my intro, that's my bio for President Mester, because I think just reading your standard bio, I think it warrants more than that. And again, a very intimate lunch, I feel like we can be that way here. But extremely honored to have you speak today. Please, President Mester, come give us the good word. Thank you.
Well, thank you very much. That was incredibly kind, and I really appreciate that. And I want to say good afternoon to everyone, and I do want to thank Ellen very much for that kind introduction. I want to thank the New York Association for Business Economics for inviting me to speak today. You will have to tell me after the speech whether it's appropriate that this is April Fool's Day. I don't take it personally. I think this is what fit into our schedules, but you'll have to let me know. I do believe that one of the important responsibilities of being a Federal Reserve policymaker is to share his or her economic perspectives with the public. And Congress has wisely given the Fed independence in making monetary policy decisions in pursuit of our statutory goals of price stability and maximum employment. And I say wisely because a body of research and practical experience, both here and abroad, show that when central banks formulate monetary policy free from short-run political interference, the policy is more effective and yields better economic outcomes. But to preserve that independence, the central bank must be held accountable for its policy decisions. And I think a key component of that accountability involves policymakers providing information to the public on their evaluation of economic conditions, their outlook for the economy, and the rationale for their decisions. Now, as you all know, at its March meeting about 2 weeks ago, the Federal Open Market Committee made one of those decisions. It decided to maintain the target rate for the federal funds rate at 1.25% to 1.5%. The FOMC also released a new set of economic projections, something that it does 4 times a year. And today I plan to discuss my outlook for the economy and monetary policy. Now, in doing so, I realize I'm going against the teachings of Lao Tzu, the 6th century BC Chinese philosopher, who said, "Those who have knowledge don't predict, and those who predict don't have knowledge." But I'm going to take my inspiration from a more modern thinker, somewhat more modern, Henri Poincaré, this 19th century French mathematician, who said, "It's far better to foresee, even without certainty, than not to foresee at all." So before I discuss what I foresee, I should remind you that the views I'll just present are my own and not necessarily those of the Federal Reserve System or my colleagues on the Federal Open Market Committee. Despite the gyrations in financial markets at the start of the year, the underlying fundamentals of the U.S. economy remain sound. I expect the economy to grow at a moderate pace of 2.25% to 2.5% this year, slightly above its longer-run trend, and sufficient to generate further job gains and a further reduction in the unemployment rate this year. I anticipate that inflation will continue to move gradually up toward our target of 2% over time. In my view, it'll be appropriate for monetary policymakers to continue to gradually reduce the level of accommodation this year. Now, in putting together my forecast for the March FOMC meeting, I incorporated the new information we had received since the December FOMC projections. I know that many people in this room have to forecast at a much higher frequency than 4 times a year. So let me assure you that policymakers are also constantly assessing incoming information for its implications for the outlook and the risks around the outlook. This information includes official statistical releases and the reports we garner from talking to our boards of directors, advisory councils, and other contacts in our regions. It's important that policy be data dependent, meaning that policy should depend on economic and financial conditions and how they evolve, to the extent that those conditions have implications for the median run outlook and risks around the outlook. Now, the focus is on the median run outlook because that's the time horizon over which monetary policy affects the economy. But we live in a high-frequency world. Measures of stock market volatility like the VIX attest to that. The market gyrations at the end of last year and the beginning of this year were notable. The declines in global equity markets partly reflected market participants' reassessment of the outlook for global growth, as well as their views on how effective policy actions taken abroad will be. Now, over the past month or so, we've seen some stability return to the markets. Volatility has declined, stock prices have risen, and credit risk spreads on corporate bonds have narrowed. As a result, on balance, financial conditions are only slightly more restrictive than they were in December. While less volatile than financial market indicators can be, economic data can also vary quite a bit from month to month. Data-dependent policymaker does not mean that policy will react to every short-run change in the data. That would be a mistake. One of the challenges for monetary policymakers is making low-frequency policy in a high-frequency world. We need to extract the signal about where the economy is headed from economic and financial market information that can often be quite noisy. Now, my own forecasts tend to have some consistency over time because I try to focus on underlying fundamentals in the median run outlook. That said, I have made some changes to my outlook since December. Most of the changes have to do with my longer run projections. In particular, the cumulative evidence since I last adjusted my longer run projections has led me to slightly move down my estimates of longer run growth, the longer run unemployment rate, and the longer run Fed funds rate, each by 25 basis points. My longer run growth and unemployment rate estimates had been on the high side of FOMC projections. Of course, it's important to remember that because of the considerable uncertainty around estimates of potential growth, the natural rate of unemployment, and the equilibrium real interest rate, the differences across FOMC participants' longer run estimates are not statistically significant, nor are the 25 basis point reductions I made to my own estimates. Nonetheless, I wanted to recognize that the moderate growth of around 2% that we've been seeing during the expansion has been sufficient to generate a significant fall in the unemployment rate while inflation has remained low. That combination of moderate growth, continued improvement in labor markets, and low inflation persuaded me that it was time to take that evidence on board and to move my estimates of the longer run values down a bit. So I now predict longer run growth at 2%, the longer run unemployment rate at 5%, and the longer run Fed funds rate at 3.25%. In terms of the forecast, as I mentioned, I anticipate that growth will pick up to 2.25% to 2.5% this year. That's slightly lower than my last forecast and reflects both the weakness we saw in the fourth quarter, which suggests that the economy entered 2016 with a little less momentum and slightly tighter financial conditions, which partly reflect somewhat slower growth abroad. So far, the information we have suggests that growth in the first quarter will remain near the fourth quarter's pace of around 1.5%, but there's still more information coming in. Consumer spending, which makes up about 2/3 of output, has been one of the economy's strengths, although it too has shown month-to-month volatility that we need to smooth through. Consumer spending has been buoyed by continued improvement in household balance sheets, growth in personal income reflecting progress in labor markets, and lower oil prices, as well as highly accommodative monetary policy that has kept borrowing rates low. The drop in gasoline prices from $3.36 per gallon in 2014 to $2.42 per gallon in 2015 saved the average household about $700. The U.S. Energy Information Administration now forecasts that gasoline prices will average $1.89 per gallon this year, which would mean another $400 in cost savings for the average household. I believe we are seeing a positive effect on spending from lower gasoline prices. Auto sales were particularly strong over the past year, hitting a new record of 17.5 million, and many of these were SUVs and other larger vehicles. Instead of spending it, some households may be choosing to save some of the windfall from lower gasoline prices. We've seen the savings rate rise. Or they may be using it to pay down debt. Either way, the improvement in balance sheets will help support future consumption. The housing sector has also shown steady improvement, and I expect that to continue. Total sales of new and existing homes have been rising slowly over the past few years. Existing home sales have made considerable progress in approaching the average level seen before the run-up during the housing bubble, while new home sales still have some ways to go to reach that milestone. Housing starts have been moving up, but they're still below the levels consistent with projections of household formation over the longer run. And in some markets, the supply of housing hasn't kept up with demand. So there is some chance we will see an acceleration in construction this year. Mortgage rates are low, but households have been appropriately careful in not taking on more mortgage debt than they can handle, and banks have been lending to those with good credit quality. House prices have been rising at a 5 to 6% pace on a national level. This has allowed households to rebuild some of the housing equity they lost during the housing bust, another factor that will support consumer spending going forward. Now, while residential investment has been improving, business fixed investment remains weak. The sharp drop in oil prices since mid-2014 has benefited consumers, but it's weighed heavily on firms in the drilling and mining sector, on their suppliers, and on regions whose economies depend on the energy sector. Firms tied to the sector have responded by cutting jobs and reducing investment. Some firms may face bankruptcy and will need to merge. In the face of low oil prices, I expect this sector to feel continued pressure. Manufacturing and other firms exposed to U.S. trade have also had to operate in a very challenging environment. The dollar has appreciated around 20% since mid-2014. This appreciation has been a considerable drag on U.S. export growth and on manufacturing output. We can expect the dollar to remain strong because real growth in the U.S. is expected to exceed growth abroad, and interest rates in the U.S. are expected to be higher than those in our major trading partners for some time to come. However, the rate of appreciation of the dollar has slowed, so the direct effect on U.S. net exports will likely lessen over time. Indeed, after last year's deceleration in manufacturing output, several surveys suggest that manufacturing activity may be stabilizing. These include the national survey conducted by the Institute for Supply Management, as well as the regional surveys conducted by the Dallas, New York, Philadelphia, and Richmond Federal Reserve Banks. As this review suggests, some parts of the economy are doing better than others. But the message I take from U.S. economic performance is that despite financial market volatility, despite the pain inflicted on the energy sector from falling oil prices, and despite the relatively weak growth abroad, the U.S. economy has proven to be remarkably resilient. Strong evidence of this resiliency is seen in labor markets. The The unemployment rate is now half of what it was at the peak of 10% in October 2009. Over the past 2 years, we've also seen significant improvement in other measures of the underutilization of labor. The share of workers who are working part-time but who would prefer to work full-time has declined significantly, as has the number of people who have only been looking for work sporadically or who have been discouraged from looking at all because they don't think they'll find a job. Since its low point last September, the labor force participation rate has risen by 0.5 percentage point and is now at a level consistent with estimates of its longer run trend. Payroll job growth has averaged more than 200,000 jobs per month over the past 2 years. And while there have been ups and downs in the monthly reports, as there always are, I think it's notable that even as output growth slowed during the fourth quarter of last year, firms continued to add workers to their payrolls at a very good pace. The data from the Bureau of Labor Statistics Job Openings and Labor Turnover Survey, or JOLTS, show that some dynamism is returning to the labor market. The rate of job openings is stronger than during the previous expansion, and both the hiring and quit rates have risen to levels suggesting that firms are looking to hire and workers are confident enough to be looking for better jobs. Wage acceleration typically lags the improvement in labor markets, and this time is no different. Average hourly earnings have only slowly accelerated over the past few years, and the Employment Cost Index, which measures total compensation, has risen to about 2% a year over the past 3 years. Some of the anecdotal reports suggest that wage pressures may be building. We've heard for some time from employers in our region that it's been hard to find workers with the necessary skills in certain higher skilled occupations, including information technology, healthcare, and specialized construction. Firms had to increase wages and benefits and often offer and sweeten retention packages for these types of workers. But now we are continuing to hear increasingly from firms across the service sector that they're having difficulty finding workers in lower skilled and less specialized occupations like bank tellers and retail staff. As labor markets continue to tighten, I expect to see wages accelerate somewhat. Now, I don't want to underestimate the difficulty that many workers have had during the recession and slow recovery, and that many continue to have. For example, in my regions, those who have lost jobs in the mining, oil, and gas sectors in Appalachia and eastern Ohio have been slow to find new work because the economies in those areas are not well diversified. I believe there are longer-run workforce development issues affecting U.S. labor markets, and the deep recession and slow recovery have exposed and exacerbated these problems. As a country, we need to ensure that people can enter and remain productive members of the labor force to raise our standard of living and make us more competitive in the global economy. The question is how to do that. I don't believe monetary policy would be effective in addressing these longer-run problems. More than that, trying to rely on it to do so is counterproductive because it takes the focus off of programs and policies that can help to prepare and sustain workers in the modern workforce. So from the standpoint of what monetary policy can do, the totality of the evidence suggests to me that the economy is basically at the Fed's mandated monetary policy goal of maximum employment. However, I do believe that government policy and programs, such as educational assistance and retraining programs, have a role to play in addressing these long-run labor force challenges, and it should be brought to bear. Price stability is the other part of the Fed's dual mandate. Inflation has been running below the Fed's goal of 2% for quite some time. Low inflation partly reflects the effects of earlier declines in the price of oil and other commodities since mid-2014, as well as the appreciation of the dollar, which has held down the prices of non-petroleum imports into the U.S. But the most recent data have been somewhat encouraging and in accord with the pattern anticipated by the FOMC. As oil prices and the dollar have shown some stability of late, the headline and underlying measures of inflation have moved higher. And these moves are not just 1 month's number. Headline and core inflation, as measured by the year-over-year changes in the underlying indices, have been moving up over the past year. Headline PCE inflation has risen to 1% from 0.2% at the start of last year, and core PCE inflation is 1.7% compared to 1.3% a year ago. Core CPI inflation is now above 2%. The Cleveland Fed's median CPI inflation rate is 2.4%, and it too has been rising over the past year. Stable inflation expectations are an important component of inflation dynamics. In my view, inflation expectations have been relatively stable, even in the face of sizable declines in energy prices. Market-based inflation compensation, which measures the difference in yields between nominal Treasury securities and Treasury inflation-protected securities, has fallen by more than the survey measures of inflation expectations. But movements in inflation compensation have been highly correlated with changes in oil prices. And in this period of heightened market volatility and flight to quality flows into U.S. Treasury securities, I take less of a signal about inflation expectations from the market-based measure of inflation compensation. Various models suggest that the movements in inflation compensation more likely reflect changes in liquidity premia and inflation risk premia rather than changes in expectations. Based on the evidence at hand, if the real side of the economy continues to perform consistent with my projections, I expect inflation to remain low this year, but to gradually move back to our goal of 2% over the next couple of years. And I'll continue to monitor all the measures of inflation and inflation expectations to assess whether this forecast is on track. Of course, we have to recognize that the economy rarely evolves exactly as expected. And the world is a dynamic place. The economy is hit by shocks, both positive and negative. So any economic forecast is surrounded by fairly wide confidence bands, and mine is no exception. I see risk on both the downside and the upside around my forecast. If the dollar were to appreciate more than I've assumed, perhaps because of weaker growth abroad, or if there were a significant further decline in oil prices rather than a stabilization, then growth and inflation could be lower than in my baseline forecast. The actions taken by several foreign central banks to increase monetary accommodation to further support their economies may help to mitigate some of this risk. Because inflation has been undershooting our goal for some time, many people have quite reasonably been focusing on the downside risk to inflation. But it's also good to keep in mind that, according to analysis by the Cleveland Fed staff, over the last 15 years, historical forecast errors from several highly regarded inflation forecasting models have skewed to the upside. In other words, the models have tended to underestimate actual inflation. While the steep declines in oil prices have kept inflation low, in the current environment, low oil prices may also pose an upside risk to inflation over the median run. They may end up spurring stronger than expected consumer spending, and this, combined with accommodative monetary policy, could lead to a faster increase in inflation than projected. The intense volatility in financial markets that we saw at the end of last year and the beginning of this year has subsided. But were it to intensify and be sustained, this could lead to a broader pullback in risk appetites among investors, businesses, and consumers, which could dampen the U.S. economy. I note, though, that even during the recent turbulence, we did not see this. Focusing too much on signals from market volatility is also a risk, as messages from the market can turn around quickly. It could be that if markets remain relatively stable, businesses may begin to feel more secure, and investment spending may pick up more than expected. The resiliency of the U.S. economy throughout turbulent times is worth remembering as we aim to set monetary policy that will promote our longer-run goals of maximum employment and price stability. Given actual and expected economic performance, the risks around the outlook, and the progress towards our policy goals, my assessment at this time is that it will be appropriate to continue to gradually reduce the degree of accommodation this year. Gradual normalization means that monetary policy will remain accommodative for some time to come, providing support to the economy and insurance against downside risks. I think that's appropriate given some of the forces still affecting our economy. For example, slow growth abroad, appreciation of the dollar, somewhat more restrictive financial conditions, and the continuing rebalancing of supply and demand in the energy sector. Now, as I mentioned earlier, at our March meeting, the FOMC maintained the target range for the Fed funds rate at 0.25% to 0.5%. I did not dissent from that decision. Even though I expect it will be appropriate to continue on the path of normalization this year, I recognize that the data we had on the first quarter were limited. I agreed that a reasonable case could be made to wait until more information could be gathered and assessed to see if they confirm that the economy is evolving as anticipated, namely, resumption of the moderate growth trajectory with continued improvement in labor markets and inflation on track for a gradual return to 2%. I don't think the FOMC is behind the curve, but while there are risks to moving too soon, there are also risks to waiting too long to take the next steps on the normalization path, given the lags with which monetary policy affects the economy. We live with uncertainty, and one could always make the case that we should wait to act until we gather more information. But waiting until every piece of data lines up in the correct way means waiting too long and risks having to move rates up more aggressively in the future with negative impacts on the economy. Similarly, forestalling rate increases for too long in light of financial market volatility that doesn't affect the outlook may simply produce more volatility in the future if we find ourselves having to increase rates more aggressively than anticipated to achieve our goals. Of course, the actual path the funds rate will follow will depend on economic developments and how they affect the outlook. And as we've seen over this expansion, things can take unexpected turns, and we want policy to appropriately react to changes in the median run outlook. The policy path I foresee as appropriate today is slightly more gradual than the path I saw in December, partly because of the slight downward revision to my growth forecast, but mainly because I now estimate a lower, longer run equilibrium interest rate. But these are small changes. The important point is that the economy has shown considerable resiliency, and in my view, the outlook and risks around the outlook will likely support gradual reductions in the degree of accommodation this year. As indicated in the March Summary of Economic Projections, or SEP, the other FOMC participants also currently anticipate that it will be appropriate for the funds rate to move up gradually over time, with the median path across participants now slightly shallower than in December. Now, a lot of media commentary is focused on this somewhat flatter policy path. To my mind, this change in the path is an excellent illustration of how our policy is data dependent. There were slight reductions in the participants' economic projections between December and March, reflecting incoming economic information, including weak fourth quarter US growth, lower estimates of global growth, volatility in financial markets, and somewhat tighter financial conditions. Each participant took these developments into account when revising his or her projections and the policy path that participant thought was appropriate to achieving those outcomes. Because there's uncertainty around each participant's projections of growth, the unemployment rate, and inflation, there's also uncertainty around the appropriate policy path. Thus, no one should read the median path in the SEP as a promised policy path. Policy is not on a preset course. I know you've heard that a million times. The actual path of the Fed funds rate will depend on the economic outlook and risks around the outlook. But the median policy path and changes in that path over time help to illuminate participants' reaction functions, how participants believe policy should systematically respond to changes in economic conditions that affect the outlook. I believe the discipline of forecasting how the economy might evolve over the median run and the uncertainty around the forecast is an essential part of the framework for setting monetary policy. It provides a useful methodology for avoiding too much focus on short-run changes in the economic data or volatility in the markets. It allows us to do low-frequency monetary policy making in a high-frequency world. It forces us to consider how changes in the economic and financial data may or may not change the median run outlook, the risks around the outlook, and the appropriate policy path. It's this construct through which our policymaking can be made systematic, yet responsive to the evolution of economic conditions. The outcome of this process, the projections of economic outcomes, and the policy paths thought appropriate to achieve these outcomes is summarized in our SEP 4 times a year, allowing the public to better understand how the assessments of the economy and monetary policy are evolving. I view this as essential transparency, which is why I believe the SCP continues to be an important part of FOMC communications. Thank you very much for your attention.
Thank you all. So you'll notice I am projecting, so please do the same. We're going to have a healthy question and answer session. I encourage you, when we call on you, to stand up and maybe give the name of the firm that you're with, or just your name if you're not with a firm. So I don't mean to assume everyone here is with a firm. And please try to limit it to one question. Oftentimes, we stand up and 3 questions later. That just means that President Mester gets to choose which one of them to answer. Anyhow, so hands up. Charlie, here? We'll start here at the head table. That's the benefit of being at the head table.
Charles Steindale from Ramapo College. So, President Mester, I understand your talk and I understand where it's coming from. The U.S. economy has been surprisingly resilient, and it looks like the FOMC will resume its path of gradually normalizing policy and understand your view of the risks. And the real question is what happens if that's wrong. Obviously, if the economy proves stronger, inflation proves higher. That's a simple answer. You raise rates more rapidly. The question that people have been asking, and I think Chair Yellen was addressed that earlier this week, and certainly they're dealing with it in Europe and Japan, what happens if it's the other side when we're still, even after the recent increase, we have the funds rate at 25 to 50 basis points. What is the contingency plan?
So we still have other tools in the toolkit, right, including the size of the balance sheet, right, the maturity of the structure of the balance sheet, right, and keeping interest rates lower for longer, right, or more explicit forward guidance. So I think those are the tools that we still have in the toolkit. And various studies have shown that, quantitative easing or LSAPs or whatever, the lingo you want to call it, right, has actually been effective. So, I think there's contingency there. I would say that adjustment in the policy path, right, whether it's steeper, that's reflective of, right, some of the risks around the outlook, and taking on board some of the, softer data at the end of last year. So,
Can I ask your views on negative interest rates, since that's obviously a popular topic?
yes, yeah, so I know that people have been talking about it. It's not an active discussion at the FOMC. However, I'm not really in favor of us thinking about it here. I think we'd have to do a lot more work to even imagine that. And I don't foresee that we're going to need to go there. So, to my mind, we have other tools that I would definitely put on the table first, before I would want to think about negative rates.
Another question.
Okay, I didn't hear it all.
So in your district, I'm going to project for you. So in your district, can you comment on what the net effect of lower energy prices has been, and can you comment, because it tends to be a district that's heavily auto influenced by autos, credit in the auto space, particularly subprime credit, developments that you're seeing there?
Yeah, so far the banks in our district we don't seem to have a subprime auto credit problem, at least in our banks. In terms of the net effect on the district, for sure there are places in the district that are very exposed to the oil price declines. As I mentioned in the speech, Appalachia, Eastern Ohio, and they felt the brunt of this. It's been hard for the people in those areas to get jobs, partly because the economies in those areas are so dependent on energy. And we're getting increasingly getting reports from temporary agencies that are trying to help people get work that it's going to be very difficult to find them work unless they move out of the region. So it's been a struggle for areas in the district. On the other hand, the low oil prices has been supporting consumption, and we've heard from some even businesses that say that that's been helping them as well. So how it nets out, I mean, we know that and the nation as a whole, right, lower oil prices on net are going to help us because we're an importer of oil. But, it's been a struggle in our district.
Question here.
Chris Wolf, Merrill Lynch. One of the themes at Davos this year was the fourth industrial revolution, really robots and kind of the deployment of technology across a number of manufacturing dimensions. Could you talk how you think about technology impacts things like labor force growth, inflation overall, wage inflation in particular, and ultimately how you think about risk premium?
Yeah. Okay. So I guess I'm I'm going to get around to answering your question. So in terms of sort of like secular stagnation things, right? So is technology, actually productive technology, or is it just sort of, not productive? I'm in the I think technology is productive technology, and I just don't believe that we're not going to have any kind of innovation that's going to be helpful. That said, right, transitions, right, are hard, very hard. And I think part of what we've seen, certainly in our district, but I think in the nation as a whole, is like the transit, and I think the recession was so deep that it really highlighted this, probably exacerbated it as well, but it really exposed it, is that we should do better in terms of distributional things when these kind of, come in, technological change comes in, right? But, all the manufacturers in our areas are doing these kind of things with robots and taking it on board. But then how do you train those workers to transition? And that's very challenging. And I think we as a country need to do a better job at that. In terms of, if you think about productivity growth, structural productivity growth, of course, the technology is a very key component of that, but also investment is, right? Capital, building up capital, right? So there's two kinds of capital. There's the human capital, and then there's the, hard capital, equipment and software. Both have been weak, I think. And again, I think as a country, we have to do those kind of investments. I think maybe Davos focused on the right thing. And the question is, how do you do it? What are the right tools to bring to bear on that? And I think as a country, we should be spending more time on that question. And I think as a profession, economics, for a long time, we've had, I'm going to use the word luxury, but we've had the luxury of ignoring distribution, right? I mean, we haven't really focused as much on distributional aspects. I don't think we have the luxury of not focusing on distribution. Distributional aspects are going to be, I think, a very important thing in the rest of our lives. I mean, I think that's like a key thing that we have to study harder, and not just say we're going from one steady state to another, and the transition path we don't care about. You got to care about the transition path.
Anne-Marie Newland, I retired from Federal Reserve Bank in New York for quite a while now. I want to ask about the 2% inflation target, which, having lived through the 1970s and very rapid inflation, a 2% goal would have been viewed not as an ideal, but probably the best we could do to get to a zero. And the view has shifted rather dramatically on that. In fact, some members of the FOMC would argue that about 2% would be more desirable. Having lived through a period when the Phillips curve completely collapsed, I like to say the chart looks like a plate of spaghetti, because more rapid inflation did not produce more jobs and did not produce more growth. I've been doing a lot of thinking about what the right goal should be. And one hypothesis that I've been playing with, and I haven't heard anybody mention, maybe I just haven't read the right literature, is that the higher the sort of underlying potential growth of the country, the lower the inflation rate can be. I mean, China for a while in the 1990s had deflation and still kept growing rapidly. This country in the late 19th century, same thing. Japan, which has a dreadful demographics, can't grow rapidly unless they change their policy toward immigration. So they have a real problem with even a little deflation, which everybody sort of magnified and said even a little deflation is awful. Mm-hmm. But anyway, that's enough philosophizing. But I just want to get a little bit of thought on, is 2% the right target? Should it be lower? Should it be higher? And why?
I'm comfortable with 2%. I think your thesis is worth thinking about, because it's basically saying that, if the zero lower bound is more coming into play more often, it would in your scenario of low underlying growth, right? Then that would be a reason to have a higher inflation rate, right? So I think your thesis has some merit. Certainly, but I'm content with 2%. I mean, I think that, it balances some of the issues about zero lower bound. It also balances against sort of the cost of a higher inflation rate in terms of the inefficiency. And I want to point out that, as you probably all know, in the beginning of the year, we changed our we added a word to our long run strategy document that basically explains that, it's a symmetric inflation goal. And I thought that was important, just to clarify. It's not a change, it wasn't a change in any way, but just a clarification that, sometimes inflation will be below 2%, sometimes it'll be above, but our goal is 2%. And I think I'm very comfortable with that as a goal.
So the 2% is based on the idea that at least for quite a while, the normal underlying growth potential of this country is low. Presumably, it's not low forever.
Well, it depends on what you mean by low. I mean,
2% is low. 3% is more, quote, normal.
what are we talking about, the inflation rate, or are you talking about the normal growth rate?
GDP.
Ah, okay. Yeah, I mean, my long run GDP forecast is 2%.
But how long is your long run? I mean, as baby boomers retire, you've got an adjustment. It's a point we'll all be retired, and the millennials will have acquired the skills they don't yet have.
Yeah. I think there are things that the country can do, right, that might affect the long run growth rate of the economy. Monetary policy isn't going to be affecting that. So if I'm forecasting what I think the long run growth rate of the economy is, 2% seems about right, given the demographics and given the changes that we expect.
I think that underscores why there's always so much disagreement about potential.
Exactly. Why large error bands around potential.
What it was way later.
Yeah,
after
exactly.
the fact.
Yeah, exactly.
So maybe I can just selfishly get a question in here. It's the benefit of being the president, right? So I'm just going to get one in here. You're on the subcommittee for communications, and after the January meeting, we got the minutes from that meeting. We haven't gotten the minutes from the March meeting yet, and there was discussion of fan charts. And I think more so along sort of a vein that you've been pursuing and trying to properly communicate that forecasts can be uncertain and don't take everything as written in stone. Where do you see something like the fan charts going? Have there been other discussions about honing the communication policy of the Fed via its materials? How is that evolving?
Yeah, so we're always constantly working as the Fed as a whole, but also in the subcommittee, to try to make our communications as transparent and actually communicative as possible. Because, just dumping a lot of information out there isn't necessarily good communication. So, it's an ongoing project. I've said this before, it's kind of like, it's a journey. We haven't gotten to a destination yet. We're going to continue to fine-tune the work. My own personal view is I appreciate fan charts because I think it's actually good to remind people that, these forecasts are forecasts. You think about an inflation forecast and you think about the air around an inflation projection 1 year out is like plus or minus 1 percentage point, right? And so sometimes when you look at the dots or you look at any of the other variations in across FOMC participants, it looks like, wow, there's like a disagreement there. If you actually put fan charts around any of those variables, you'd see like they swamp any disagreement among FOMC participants. So I think my own personal view, and I'm only speaking for myself, is that I would support doing fan charts, but it's to actually do it correctly and how you would do it, it takes some more further thought. But we're always constantly trying to work to communicate better.
Wonderful. I was going to say one last question, but we discussed how dangerous one last question would be. Here it is. I think you had your hand up a few times. Yes, so right here.
Eric Van Nostrand from Blackrock. On the outlook for core inflation, you cited another leg higher in the dollar as a possible downside risk. But it seems the big debate around the current outlook for core inflation is whether there's remaining pass-through from the 20% appreciation we've seen in the past 2 years. Mm-hmm. What do you think about whether there's much further down?
Well, I think I think inflation will remain low this year. I think we've seen some upward movement in core inflation already, but some, there may be special factors and some pass. There'll still continue to be some pass through. But again, my view is that we're going to see this gradual continuing back up to 2% inflation over time, over the next couple of years. So. Thank you.
so
Thank you very much for your attention.